I want to thank several people, Gail Donovan, Nicholas Sochik, and Ivan Petrovich, and Walia Ahmed, as well as Rachel Courtney, all of which put together this event. And I want to thank the TD Bank administrative staff. Are you here? Raise your hand if you're here. Thank you so much for putting this together. It's pretty incredible. I want to tell you briefly about our company. Ariel Property Advisors is a real estate investment services company with three groups. The first one is investment sales. We sell buildings throughout the city of New York. We also have a capital services group where we place debt and equity throughout the nation. And lastly, we have a research and advisory arm. Much of the information here and here with you is from that specific group. We're a 65-person operation, 7 partners. All of them are here. If you don't know them, get to know them, you'll benefit from that. We also partnered up with Global Real Estate Advisors, GREA. We today have 12 locations in the United States that we can do business in. And with that, we're going to talk about the investment real estate market in New York City. And in 2025, we've seen something super interesting when it comes to investment. We saw investors follow the rule of 3. Number 1, they look for bases and value. Number 2, they look for fundamentals that are growing. Number 3, they look for policy alignment. And that's going to be here around everything that we speak about in this specific presentation. There were $35 billion of transactions, a 24% increase year over year. One of the interesting things that happened was that some sellers decided to stay in, which again tells you about the conviction in the real estate market in New York City. But you know what else? We've seen momentum. The second half of 2025 was much more robust. And here you have 5 of the transactions, the largest transactions that took place then. It's Class A office, it's high-end residential rental, it's ultra-luxury condos, and it's retail. And we're going to talk about several of these throughout the presentation. We're going to start with multifamily, then we'll go into office, then development and retail. And at the end, we're going to talk about the watch list, and then we're going to go to the panel discussion, as Gail mentioned. Let's start with the multifamily asset class. And here too, we have 3 categories. Number 1, rent stabilized multifamily. Number 2, we have affordable housing multifamily. And number 3, we have free market multifamily. Very excited to have Joe Fingerman here with us today. Joe is going to speak both about the free market and rent stabilized, as he knows them well. And we also have Gleb Lerman, who's been in the industry of affordable housing for 20 years, and we're excited to hear his insights. Let's start with a quote. This is Milton Friedman telling us that policies are determined not by their intentions, but by their results. And guess where I'm going to start? I'm going to start with rent-stabilized multifamily, where HSTPA, the Housing Stability and Tenant Protection Act of 2019, changed the rules. What happened? Well, you cannot increase rents or substantially increase rents even upon vacancy, which means that there's a lot less incentive to put money into buildings. So tenants today live at the end of the day in worse conditions. What else? COVID changed the way collections are happening. We have a lot of economic vacancy. And lastly, interest rates have grown, as everybody knows, since 2022. Expenses rise by 2x compared to the Rent Guideline Board. What are the results? Well, as I said before, it's about tenants not living in the best conditions, but it's also about valuations that dropped drastically last year and over the past few years, and the amount of transactions, which is less than half than what it was prior to 2019. So what's the motivation to sell? Well, clearly there are some people who have to sell and some lenders who have to sell, but there are also people or investors that had enough. For example, Pinnacle, or the Pinnacle portfolio bankruptcy, is selling now at about 60% less than what it could trade back before 2019. Related, on the other hand, didn't have to sell, but decided to leave that rent-stabilized industry with a 24% discount last year. There were smaller transactions as well that took place in the rent stabilized world, discounted as well, invested by private clients and family offices. So why are these buyers buying? They're buying because of the low basis, and they're expecting the policy misalignment to change at some point, which makes some sense. Now, you want to think about how it could change. Some of it could go through an affordable housing play, which is the second multifamily play there is. And we've seen one transaction doing that. The Lefrock transaction last year went into marketing as rent stabilized, but closed as an affordable housing transaction where the mission-driven capital here partnered up with the city, extended affordability for the lower income tenancy, rehab the buildings. The city can say now they have preserved 755 units and the tenants live in good conditions. And that's exactly what affordable housing is doing. It's that partnership between mission-driven, city, state, and sometimes federal government. When it's there, it's successful. For example, Ocean Park, which is a property that our company, Ariel Property Advisors, brokered from Related to Treadway, is a good example of it. Treadway committed $15 million of rehab for this property, extended affordability for the betterment of the tenants there. And Blackstone, which refinanced, decided to stay in the strike-down deal as a result of having this partnership as well. More importantly, the lender here was willing to refinance. So affordable housing multifamily is doing well. It'll do better probably this year from a transaction perspective just because of the amount of assets we have in the inventory and our competition has in the inventory. So we expect to see that move forward. Enough about regulated buildings. Let's talk about free market buildings, which are close to 70% of all transactions. Here, it's all about fundamentals. We've seen growth of rent by 10% year over year. We've seen the same rent grow 51% when you look at it over a period of 5 years. And that helped valuations go up in the past year by 6% for free market buildings, by 10% for the past 5 years. And we still have way to go to get back to 2017, which was the peak year. So that's why investors are buying. That's why larger investors are staying in deals. You've seen that with Brookfield bringing McCrory into their deal on Waterside. You've seen Steiner bringing Meadows and recapitalizing and staying in his deal. And you've seen Taconic bringing in Aris to stay in their Hell's Kitchen, relatively newer building. Free market wasn't just for those who stayed or just valuations. It's also about the basis. And in some cases, like Riverbank, JP Morgan decided to buy in for less than $630 a foot with a value-add intention because of that basis. Same with A&E and Benchmark on the Upper East Side and Upper West Side, respectively. And lastly, when it comes to free market buildings, we have the smaller tax class protected buildings, less than 10 units in many cases. And there you see investors that are private, that are international, like this Japanese investor in Brooklyn, and institutional like Carla. The multifamily market has been at 20 or 25% of all transactions in New York City, where office was a third of all of the transactions, or $11.6 billion. In office, we have the Class A office buildings, like this one, and we have the Class B and C office buildings. The Class A experience most of the dollar transactions, Class B and C, most of the transactions, so smaller transactions in general. So Class A, $10 billion, also fundamentally driven. The price per foot is closer to $90 on average, but if you're in a building like this, you're all the way up to $300 a foot, which is pretty interesting and drives many larger transactions, like Rhythm buying the Paramount deal. This $3.8 billion is our estimate of what the values of the buildings that are in New York City. But there were also individual large transactions like 590 Madison Avenue, where a pension fund decided to recycle capital and not refinance. They weren't distressed. They just wanted equity out. RXR, Elliott, and Baupos jumped in to reposition this 87% occupied building, to reposition the retail, and get a loan also from Apollo. What's interesting is that Apollo was also a tenant in this building for about $100 a foot. So a lot is happening in the Class A office. And the last two examples, which I think are interesting, are 1345 Avenue of the Americas, where Fisher Brothers refinanced and brought in Blackstone to recapitalize the deal, and 1211, which is Ivanhoe bringing RXR again to recapitalize and to refinance the deal. Again, two owners that decided to stay in and recommit. What about office conversions? Did they happen? Yes, they did. Oh, but before that, we're going to talk about Class B and C because I forgot. So Class B and C is has been a lot less transactional, or more transactional, less dollar value. And here it's all about the basis. What happened last year, for the first time, we had some visibility to tenancy that's willing to pay $50, $60, and $70 per square foot, which means that if you buy it at the right basis, you can actually reposition the building and make money as an office building. And that's exactly what happened with Empire on 36 and 38. That's exactly what happened with 60 Guilders at 1370 Broadway. Look at the discounts. They're deep. The basis is important here. Should also mention that many of these transactions were lender-led and with some short sales as well. And now we can talk about conversions in the section of development. And that's where I want to start. I want to start with development. $7.1 billion, 26% increase year over year in three categories of development: office to resi conversion, residential rentals, and residential development, and condominium developments as well. Very, very excited to have Issac Hera here from Yellowstone to talk about conversions and development in general, as well as Sam Alison-Mayne, who is going to talk to us both about rental and condo developments, as he's doing a lot of that in Brooklyn. So thank you for being here. Let's start with office conversions. We've seen a drop in volume of transactions for office to resi conversions. Only 50% of what we saw last year. But the amount of permits went up by 60%. What does that mean? Two things. Number one, those who bought in 2024 probably permitted last year. But also, owners who own office buildings that could be converted chose to convert versus sell, like File and Ruby Schroen and Lax. There were bigger transactions too. I mean, we've seen Van Barton buy the Archdiocese building. And why is that? Policy alignment. So we have the City of Yes, we have rezonings, and the 467M, which allows you to get a tax abatement if you convert from office to residential, as long as you provide some affordability and as long as you stay residential. So policy plays a major role here, and policy plays a major role in development, in rental development. We've seen growth in the number of land transactions last year, but here's what's interesting. The average buildable square foot for the lots that sold is only 48,000. What does that tell you? It tells you that the 485X, the new tax abatement, encourages smaller transactions up to 99 units. When you go above 99 units, there's a very restrictive wage requirement. So most people who buy today buy smaller deals to build smaller buildings. But some bigger buildings did trade. You see them here. That's 175 Third. You see Greenphone Landing and others. And all of those had the 421A vested, the old tax abatement already in place. The smaller deals with the 485 are the reason of the 485X, like the Clarkson deal on the East 150. And lastly, condominium. More transactions there, but what's super interesting is the ultra luxury condominium buys, like phenomenal developers like Naftali, Extell and Legion. Naftali is buying 800 Fifth Avenue for $3,000 a buildable, projecting sellouts at $11,000. Extell and Legion participated as well. What's interesting is that Extell also got the highest construction loan for, I believe, 655 Madison Avenue earlier or late last year. All right, retail. Retail has been doing exceptionally well in prime locations in Manhattan. Fundamentals. That's the reason there. It's the rents, it's the low vacancy, it's the fact that there's no new construction for retail. And it's super interesting to see who's buying. It's two types. Number one, it's the brands, the IKEAs and the Ralph Laurens, and they're joining Prada and Gucci from the year prior. But there's also savvy investors like Blackstone and Acadia that are seeing the opportunity in retail. I'm going to wrap this up. So this year, we have more mortgage maturities, about 20% more mortgage maturities than the year prior. $936 billion nationwide. That means there's going to be more decisions to be made and possibly more transactions. There's more equity. There's more debt in the market as well, which is helpful. And as I mentioned before, there are international investors. So we believe transactions will probably be higher. Now, we all ask ourselves, what is the new administration going to do here and how to view it? And I don't have a clear answer for you. But what I do want to look at is the positive side of it. They're talking about preserving some deals. They're talking about housing supply. So I want to see that, and I think that if we do, it's going to be very accretive to New York City. I started the presentation by saying that investors are looking for value, for fundamentals, and for policy incentives. I believe that all three are here with us today to increase volume moving forward and to increase value in some of the assets. And that really concludes my presentation. And I'd like to invite Ralph and the panelists here, please.
All right, thank you, gentlemen, for joining us today. Shimon, thank you for a wonderful presentation. Thank you for the partnership that we've had over these years and for including us into this extraordinary event. And to look around the room, standing room only, we've got people in the kitchen, we got people calling in that want to be part of this. I don't think we have an empty seat here, but I appreciate you all standing in the back. And we got to figure out something for next time. I think we're going to need more space. Maybe, well, in the spring, we'll open up the outside. We'll have outside seating for that. Tamika, I want to thank you for opening up today's session for us. For me, first of all, the honor that you're bestowing upon the bank and including me in that is just extraordinary. But over the years, and I remember being across the street with Shimon in those early days and hearing the story of legal outreach and the work that's done and the fact that the matriculation is 99, 100% for those students going to college. And that support and how we bridge. And what I love about this industry, and you're all, packed in this room here, is what we do in the community. And it's not just about the great work that you all do, but the commitment that you have to the people of New York, to the communities, I think is so instrumental. And so thank you for that honor. And we got to see it live here just a couple of days ago. The students were involved in that fraud presentation, which is a heavy topic. But that financial understanding, that financial grounding, and be able to have that conversation with their parents is so important for that, and we look forward to supporting that. So I've taken up a lot of airtime here, but thank you for this platform. Gentlemen, thank you for joining us. Let's get to the questions. This is a wonderful panel, Shimon, so I'm excited about this. So we'll just kind of go down and start with introductions. If I can ask you, Sam, to start for us.
It's working, yeah.
Sam, Alison-Mayne, founder of Tankhouse. I'm guessing most of you have never heard of our company. Very kind of small boutique development firm based in Brooklyn. Founded the company 13 years ago, moved to New York City 20 years ago to work in construction, actually, here in Manhattan. And then after spending some years in construction, decided to start a development company. And kind of right out of the gates 13 years ago, had like a very, very kind of intentional focus. And we can get into that a little bit later, but we pursue design-driven work for sure. And we're doing ground-up residential work, condo, rental at various scales. But I think a big part of what we do as well is kind of our approach from the beginning is to be hyper local. We live and work and develop in a single 1 mile radius of Brooklyn. So for all the brokers out there, you guys don't need to bother sending me any deals that are more than a mile away from downtown Brooklyn. in all seriousness, we've spent 13 years in that 1 mile radius and have no intention to leave it. And that was intentional for a lot of reasons. But yeah, we're 13 years into this journey, and the business is growing. We started off with, smaller condos, and have kind of built our way up, and are now doing a lot of larger multifamily. Although that's getting a little bit complicated, obviously. So we were scaling up work, and now figuring out a way to scale back down to kind of make sense of our current environment, or find sites that we can kind of break up into multiple buildings, but nevertheless have a lot of stuff in the pipeline that's really exciting, and glad to be here.
Sam, I grew up within that 1 mile radius that you're investing in, so I appreciate that. Isaac, over to you.
Issac Hera, Yellowstone Real Estate. We are opportunistic investor, lender, owner. Have currently a portfolio of about $3 billion, working across North America, operating in New York City, Florida, San Francisco, and also Toronto.
All right. Can you hear me? I guess I'll just have to be loud. Hold on. Hello? There you go. Can you hear me? Okay, here we go. So I'm Joe Fingerman. I am the president of commercial real estate at Peapack Private Bank and Trust. We are a New Jersey-based bank that's been around for over 100 years that has been making a strong inroad into the New York market. So if you haven't heard of us, I hope you do now. The bank is $7.5 billion in assets. Before I got there, I had roughly $2 billion of loans, primarily in the New York and New Jersey marketplace. So we're quite familiar with making loans in these areas. And my goal at the bank is to increase the commercial real estate lending and make it more relationship, where you are able to work with some of my partners on deposit, wealth, and other business lines. Thank you.
Thank you, Joe. Good to see you here.
Hey, Gleb Lerman, Hudson Valley Property Group. Hudson Valley is a national investor, developer of affordable housing with roots based here in New York. The two founders actually were childhood friends from the Hudson Valley, and hence Hudson Valley Property Group. We own 17,000 units, of which 200 are in the Hudson Valley. Focus has been traditionally on major redevelopment, investment, and preservation of affordable housing. Previous to this role, I worked for a New York City developer focused on preserving specifically New York housing assets. So pretty wide focus these days, and haven't been spending as much time as I'd like in New York, but we are constantly evaluating when the right time to come back into New York is. Really run two businesses. One is the heavy redevelopment using the low-income housing tax credit, and then the second business is a fund management business where we raise institutional CRA eligible capital and invest it into preservation. Oftentimes that has a lighter touch, but still transformative projects do come out of that part of our business as well. 50-person firm, and I'm excited to be here.
Wonderful. Thank you, gentlemen, for starting us off. Isaac, I'm going to turn the first set of questions over to you. If we can talk about, you're acquiring hotels, office properties, just your investment theses, how you go about it, what are you looking at, and kind of what drives you in this moment?
So we're trying to identify the situation where the value of the asset versus the price of the asset, right? There's a dislocation here. And the dislocation can be a cause of different reasons, right? It can be because there is lack of liquidity in the market. It can be because there is a perceived problem with an asset class. It can be because there are perceived issue with ownership. It can be because there is issue with the capital stack. Once we see an asset, which we like the fundamentals of the asset, right? And we identify the problem which we think, not speculate, sort of, analyze and think that we can solve the problem by different means, right? Bringing liquidity to a case where there's no liquidity, converting the use if there is a problem with the use, changing the ownership, changing the capital stack. This is when we are taking action, and this is when we are trying to take over the asset.
Outside of New York City, any opportunities you see for your business?
Yeah, we are. We were very active in New York, and typically, when people are afraid of acting, this is where we are trying to find opportunities. So, as mentioned here, right, New York went through, and I'm not telling anyone anything that you don't know. New York went through, challenging times, and we were very active initially going after hotels. And when the opportunity shifted to offices, we moved to look into offices. But yeah, we're operating in Florida. We operate in San Francisco, where again the situation is similar to New York. Maybe the recovery is not is not as quick as New York, but it's getting there, right? And we are looking also in markets in Canada. So we are working in different places.
Any thoughts of conversions in these particular properties?
So yes, we are in the city today. We go with few assets. We took over. We bought a loan from an asset on 1740 Broadway. It's on 56th Street and Broadway, which the ownership, the building was owned by Blackstone. Again, I'm stating public numbers, right? Blackstone bought a building for $600 million, invested tens of millions of dollars in the building, had $310 million CMBS loan. The building got vacant. It was, when Blackstone bought it, right, it was fully vacant. Blackstone did everything right, invested, like Blackstone did really everything right. Did a great job. The market didn't work for their benefit, and the building got fully vacant. Loan got into default, and it was published that we bought a note for $180 million. Right. Our plan is in this specific building. It's 600,000 square feet. Our plan is to convert the building to a sort of mixed use, condos and rentals. So that's one deal that we are doing. We are doing another conversion on 57th Street off 9th Avenue that we just closed a loan. Again, it was in the news for $330 million. It's a 600 Keys Hotel, 2 towers, which we are converting to also apartments. We have a 250,000 square feet conversion on 42nd Street off 7th between 7th and 8th Avenue, which we are converting to apartments. And we have a 350,000 square feet hotel, which we took over. We bought a note and we took over on Lexington Avenue, the former Maxwell Hotel, which right across the street from the Waldorf Astoria, which we are developing plans now. So very active in conversions these days.
Thank you for sharing. Sam, I'm going to turn it back over to you. When I walk the neighborhood, a lot different than when I grew up there. So I want to kind of get your perspective on what you see going forward, your development ideas. I think you said you're not looking to branch out, that's kind of the corridor you're going to focus on in the time being, but just really kind of want to get a little bit deeper, and especially around some of the city of yes and some of the incentives. Does that play into your decision making?
Play into decision making in terms of what type of projects we're looking to do and where we're looking to do them.
Yep.
Like I said, we are hyper focused, and I think there isn't much that's going to shake that. I think we're a very small company. It's 5 of us, and we have a lot of work. And I think, on the one hand, that strategy is just practical, like just being able to get to our jobs quickly, being able to stop by my project sites every day. But I think it's more than that. I think ultimately, we all feel in our company that, like, developing in a neighborhood, I think you're the most capable of doing that if you know the neighborhood very well. And another piece to that is that I think 13 years ago, we were, a startup firm that had no experience in development. And, to step into New York City real estate is there's a huge barrier to entry there, for sure. And so it's clear that we were always going to be a small fish in an incredibly big pond. And so for us, it was just a matter of shrinking that pond size down. And ultimately what that does is allows you to really kind of dive deep into the space that you're working in and get to know people and build certain political capital. And I think there's a lot of opportunity that exists by really committing to a place. And that could be sourcing deals, which becomes easier and easier. But also just knowing kind of the political atmosphere and making the community connections and all of that. So we're pretty committed to that area. And like I said, we live in that area. I think we also approach what we do with, like, we are comfortable being very exposed, making it very obvious that we're there and doing what we're doing, and taking kind of accountability and responsibility for what we do. And we genuinely love these neighborhoods. So, and we believe in them, and have since the beginning. But you know, that 1 mile radius is really interesting. I think it wasn't just a random choice. It wasn't just because we happened to live there, although we did. There was a lot going on, and there still is a lot going on, right, with downtown Brooklyn and the surrounding neighborhoods. So, you know, you know, the Gowanus hadn't even really, like, it was just like a thought out there, right, 13 years ago. And we all see kind of where that's gone, and we've spent a lot of time in the Gowanus specifically. But in terms of the types of deals we're doing, you know, I think it might sound a little bit odd, but we're looking, you know, we have 5 projects in the pipeline right now, and they range from mostly multifamily, but also some condo, and the scale is a kind of a strange range. Honestly, it's from 30,000 square feet to 600,000 square feet. I think it comes down to if we feel passionate about something and it looks like a site that's interesting to us, we'll do it, and we'll figure out a way to make it work. You know, I think in today's landscape, it's a little bit tricky. I think I don't have the stomach to develop large scale condominium projects. I think I'm very comfortable in kind of the boutique scale. I think it's just you have to have a stomach of steel to in my mind, to do a condo project over 100 units. And I need to figure out a way to get some sleep at night. So to me, I kind of bifurcate things a little bit. Like if it's over 100,000 feet, I'm doing multifamily. If it's under 100,000 feet, it could go either way, but happy doing condo. And then it's just about what the site is and what seems appropriate. But then it's getting a little tricky now too with the larger scale projects. So I think that was the thinking for a while, and now we're in a place where we're seeking out kind of that middle boutique scale for multifamily, just because 485X is complicated, to say the least, and leading to all types of weird creative solutions of finding, you know, I think we're working on something right now that's 600,000 square feet, and literally trying to figure out a way to make this 6 or 7, you know, separate buildings and filings that effectively still is just one building, right? But that also takes like a very particular site configuration to do that. That obviously can't be a tower. So yeah, I think that's
that focus, that passion. We see it in the buildings, very unique. Anything particular about the features and the development that you want to highlight about your properties?
Yeah. When we started the business, I think I started it with a partner, and I think we really went back to what we felt was neither of us are from New York, and so I think both of us were bringing kind of like art influences from other places, and I think we felt really strongly that like housing just needs kind of like fundamental qualities, and we weren't seeing a lot of that in residential real estate here in the city. And it almost doesn't matter where you are on the economic spectrum. You know, I think one of the funny things is that you could spend $100 million on an apartment in the city and still end up basically with just like a hermetically sealed box, right? Your box is just like a little bigger and a little higher up. But to us, maybe wasn't including some like kind of fundamental qualities that seem so important to quality of life. So, we've really focused on figuring out ways to bring exterior space to apartments, both, private and semi-private. We've really tried hard to figure out how we can use architecture to bring light and air to multiple orientations of units so that you don't just have kind of one wall of light and air. So I think, and then there's another piece to what we're doing, which I think is ultimately seeking out kind of architectural solutions to creating buildings that attempt to foster a sense of community within the project itself. And also an extension of that is to have some attempt at a dialogue with the fully public sphere, the sidewalk, the neighborhood. And so it's certainly kind of a design-driven approach to find
Appreciate
solutions
that.
to those things. And we've had a fun time kind of, early on. It was like a small 5-story courtyard project, which is fairly easy to conceive of how you kind of achieve those goals within that within that project type. It gets more complicated as scale increases and height increases. I think the goals that I just stated become a little bit more complicated on how you achieve those. And I don't think it was clear to us that we could. And I think it's continually kind of exciting to kind of challenge ourselves and to move away from the thing that we know how to do.
Yep.
And to jump into things that we're not entirely sure if we'll be successful at ultimately.
Well, you believe in New York. You build in New York. So you are a New Yorker despite the cross country.
I spent the first 22 years of my life in California, but I was actually born here in New York City accidentally. So zeros entity. Born on the Upper East Side. Came back here in my early 20s and have.
Great. I'm going to shift Gleb, over to you. Affordable housing, a large project out in Hempstead, I think, 420 units. Your thoughts around, how you approach that, the plans for it, just your overall thoughts on affordable housing. Obviously, top of mind here in New York City. It is an area where TD leans in pretty heavy in that space. We have expertise around the financing, but really wanted to get your thoughts.
Yes, so we are more a product specialist than a market specialist. So what we're really good at is affordable housing. And if it's in a top 20 market, which are easy to identify and study, and it lends itself well to an affordable preservation transaction, we get excited about. The specific asset in question is located out on Long Island. It's one of the largest affordable housing assets that is fully federally subsidized through a Section 8 contract, which allows tenants to pay what they can afford while still allowing the owner to collect market rate rental stream. The history of the project is that, been serving Issac County and probably some of Suffolk County for decades now. The developer or the owner was a developer that utilized the low-income housing tax credit program to rehab it 20 years ago. Since that 20-year rehab, the project has gotten older. It's a 50-year-old building. It had accumulated a lot of infrastructure-related CapEx needs. And while the existing owner is very well adapted using the low-income housing tax credit program to rehab buildings, those were no longer being made available in New York State for rehab work. The tax credit was primarily routed towards new construction for policy reasons. We happen to have both capabilities to rehab with the low-income housing tax credit, but also we raise institutional private capital and pair it with other subsidy sources. So in this case, HUD was a big counterparty on this transaction. They wanted to see the asset get another 20 years of runway on it as quality affordable housing. So it was a complicated project, but it was fairly down the fairway, and it had scale to it, which was exciting. So that transaction took about a year to consummate. The seller was very savvy on what their options are. We explain to them that we'll need to put together a comprehensive financing plan and rehab plan, and we'll close into it as soon as possible. But that required restructuring tax benefits with the local municipality, which was eager for us to come in and put another 20 years of life and extend the affordability on the project. That process was, I would say, relatively straightforward, and it's not always the case that you get government to act in a way that makes projects easy. In this particular case, they understood the importance of the project. They understood the vision that we had for the project. They looked at our resume and seen what we delivered in other municipalities, and we got pretty early support from them. Now, there was procedural steps that needed to take. We presented to municipality. There was public review process. We ultimately got an extension of the tax benefits, and we were able to do a major renovation of both base building, stuff that the tenants don't really see, like parking deck that's deteriorating but cost a ton of money, or the roof that is on its last legs, it's 20 years old, as well as a lot of in-unit work. So we do in-place rehabs, which is a complicated thing that we've mastered, where tenants are moved out of their unit for half a day. We do some work, then they get to use their unit, move them out again. We do line by line, and so we rehab, and they essentially get a brand new kitchen, brand new bathroom. There's a lot of base building improvement, like the amenities, community room, elevator work. So the other thing that we implement as part of our core process is we give connectivity to all the residents. So free Wi-Fi is now included for everybody. It's wired straight into the building. That opens up a lot of opportunities for education, telemedicine. It's surprising how many people don't have internet connectivity out the gate. So that's a component improvement. We also have very robust security implementation across the board, tech-enabled, but at the same time, we have the 1.0 of security as well. We don't cut back on that either. So it's an exciting project. We had support all around. Federal government was our partner. The local government was our partner. And we were then able to route our private capital into an exciting investment opportunity. And I think the project is going to do very well for the next 10, 15 years. And then it's probably going to need to go through this program again, or some version of whatever's the most actionable program at the time.
So that capital ability that you raise, does that give you that flexibility when you're dealing? Because you mentioned a lot of what I would consider to be amenities that are expensive. Operating expenses are pretty, probably pretty much of a strain. How are you managing that?
Yeah, I mean, there's partnership all around. A lot of affordable housing needs to be met through a public-private partnership by definition. The market isn't going to be able to produce in its current environment affordable housing for everybody that needs it. And actually, to this day, the country as a whole has massive undersupply. There's way more residents that are in need of housing than housing that we have. And then there's the quality of the housing nationally. That's a whole other issue. So to answer your question, big support comes from the federal program, which houses elderly, disabled, and other people that are just unable to afford market rate rents. This is an area of opportunity. Long Island, transit-oriented. You have job centers, you have educational centers, healthcare. So there's not a lot of such centrally located. I mean, there's private country clubs 5-10 minute drives away from this. So it's an important asset, and it's a partnership that we work with the government, that both at the federal level and the local level, that allows private capital to feel confident investing. And it's an important resource, and we feel like there's political tailwinds and policy tailwinds to this type of housing, and that's why we build a business around investing in it.
You bet. Important to tell that story. So thank you for that. All right, Joseph, over to you. 1 year of Peapack, pretty exciting, right? About a year, or is it more than a year? Tell us about that. And I'm going to take notes around your strategic priorities. What are you doing out there? I want to get a little bit of a competitive advantage. Maybe, I doubt it.
I feel like you saved like the most boring panelists for last.
Absolutely.
I'm not putting up a building. I'm not doing tax credits. I'm not only lending in a 1 mile radius. So it's a little bit more, different. But listen, I joined Peapack. It's actually a year on February 24th, so I expect a card. And Zach and I on our first day, and then we took a few more people a little bit later on, and it's been absolutely great. For those, again, that don't know Peapack, Peapack is Peapack Private Bank and Trust, based originally in Peapack, Gladstone, New Jersey, now based in Bedminster, New Jersey. Was really a 100-plus-year-old bank that was sleepy, a couple $1 billion in assets. A gentleman, Doug Kennedy, who's our current CEO, took over about 10 years ago, really tried to, bring the bank to the next level and really wanted to enter the New York City and Long Island markets. We were big in New Jersey. We were doing transactional loans in the boroughs, but just not to the scale or the relationships we were looking for. His problem was there was a lot of competition, like TD and other banks that are no longer with us, some of which I used to work for. And he saw that as an opportunity to come into the city, and we opened a flagship branch at 300 Park Avenue, which is Park and 50th, across from the Waldorf. If you have not seen the Gold Horse, I encourage you to take a selfie in front of it. It's in our window. And hired about 100 and some bankers from all these different legacy institutions that were looking, to make their next move. Seems like every meeting he was going on during the first year, my name was coming up, and he calls me in August, and I joined in February. And, we have an existing portfolio, a little over $2 billion of multifamily, retail, office, industrial, a lot of rent regulated in that. I think about 800 million, 700 million of that is rent regulated housing. So I get to spend all day long on the phone with Shimon and Vic, trying to, come up with ideas and discussions. And then we have originated as a team, 600 million in the first year, which really, got off the ground sort of April, May. That is multifamily, primarily free market, retail, both single and multi-tenant, office and industrial. And then we have an entire team of bankers. Many of them are here in the audience today that are looking to get deposits. We're not just looking to have your loan. We want a full relationship, whether that's the operating accounts for the business, for the real estate entity. We'll take your account, we'll take your mother's account, whatever we got to take, we will take. We have home mortgages, wealth, which is something we didn't have at my legacy institution. And really, we're seeing that clients are looking sort of for their next home, for that smaller bank. Listen, we're not TD Bank. That is how many trillion or Bill? We're a lot. Yeah, you're a lot. And the only thing I would say is that in 2007, when I started at Signature, which is where I was before, we were $8 billion. So, everyone remembers the last loan they closed at Signature, how much money they had at Signature, but it took a lot of time from 2007 to 2023 to get it done and to get there. So that's our goal, and that's what we're lending on. It's pretty simple.
Wonderful. Macy's and Gimbals here, by the way. So if you get that reference, let's see how many. I don't think the young people are going to get that reference. Maybe not.
Gimbals?
No. I might have. But when you look at market cycles, prior market cycles, how does that come into your day to day? Shimon talked about rent regulated and your experience in that. When you're looking at cycles and prior experience, how is that applying? How are you applying that into today's thought process and how you want to underwrite and build a business?
The rent regulations, which we can go through forever and ever, and it could be a panel on itself in 2019. I like to tell people, it was 3-2 in the ninth inning. We had the third out, and they said, we're going to play one more inning. It totally changed the game on us, and that's really, the way we look at it. I will tell you that we're not going deep right now in there because there is a lot of stress in these portfolios. We have owners that, aren't able to increase rents. They're warehousing units because they can't, rent them out at a new number because they can't afford to renovate them for the rent increase they're going to get. Deferred maintenance, interest rates, insurance costs are through the roof. So it's for what was Signature was probably, the top 5 New York City multifamily rent stabilized lenders, probably 4. I would say it was Chase, New York Community, and then us. It's a big market that we've left, and it's something we've left behind right now because there's just such uncertainty in the market. We're hopeful that things will change, and everyone forgets that a lot of what has to happen in Albany, not in Mamdani's office. So we're hopeful that there's just little things that can happen. I don't think there's a wholesale change out there. Today we're looking at sponsors that we have a long track record, sponsors that have experienced trouble but sort of did the right thing, and that can be defined numerous ways. It doesn't mean that if you ask for a forbearance one time at Signature, you can't borrow here. It's just, how did you help? What did you do? How did that work? And we're really looking sort of for that relationship. So we don't really want the transactions, and that really helps us.
Thank you for that. I'm going to kind of go to the lightning round here a little bit. I do want to touch on basically from Sam and Isaac and Gleb, what are you seeing in financing today? So we just heard from Joe and myself here, bankers, but what are you actually seeing out there in the current environment, the availability of capital? Sam, I'll start with you.
Sure. To be honest, we haven't been out looking for capital in the immediate term. I think we are we were out maybe 9 months ago for a big chunk, and things have seemingly gotten better in the last 9 to 12 months. So, I think we're going to be back out there in the next 6 months. But certainly it seems like, debt is getting, at least from where we transacted last 12 months ago, it seems like it's getting a little bit better, and it seems like the same with the equity side. So, but I mean, to be honest, we haven't been, the last 6 months it's just deal cycle wise. I think we were out there 12 months ago, and then we'll be out there again in 6. But I'm feeling good that we're going to be in a better place than we were in our last round of projects.
Thank you for that, Isaac.
So what we see liquidity in the market, right, from the lenders, right? So for good sponsors, good assets, the money is there, much more than it was before. As I mentioned, we just closed a $330 million loan on one conversions. We are about to close 2 other construction loans. One is going to be for about $460 million and one for $200 million. So we went through a process, right? And there were a lot of lenders that took part and competed for the deals, and the terms that we saw, then we're seeing now, right? Even through the process that we are going through now are getting better and better. So again, I don't know what will happen now and whether things will change because of changes that took place in the city. But currently, it seems that for the right type of sponsor, the right type of assets, liquidity is there, which is not great news for us as opportunistic investor, but that's reality.
Good to hear. And Gleb, you talked about new market tax credits. The allocations are out there. I don't know if there's another cycle coming out, and the access to capital.
Yeah, so our capital stack is, 3 components really in the affordable space. You have conventional debt, then you have purchase of tax credit streams as economic investments, and then the third is the conventional equity markets, the private equity funds. So I'll tackle them one by one. From the conventional first mortgage debt perspective, the affordable housing industry is spoiled because Capital A Affordable performs well in all cycles. It's a steady eddy, and they love that asset class. So both Fannie and Freddie, the biggest lenders, typically give the most favorable terms to affordable owners for financing, and that's remained true throughout this volatile time period. So that's good. During times of frothiness, there are bridge products that come out where people give you money in anticipation of you executing an affordable transaction. That product, the dialed down considerably. It's now dialing back up. We're hearing more and more folks reach out, hey, are you looking for bridge capital? So that's coming back into the market. So I guess it's a healthy sign, or maybe not. As far as the tax credit market, that market is facing turbulence, but that's really incremental dollars that you get to subsidize affordable housing. So you used to sell in New York the credit for 120 cents on the dollar. It's weird why someone would pay more than $1 for a tax credit. That's another geeky conversation we could have. It's now down considerably, 20%. Part of that is overall interest rates have risen. Part of it is there's competition from solar credits, which are now again getting dialed down. So that market is still healthy, just the pricing for that has reset and made a lot of deals less feasible, particularly on the new construction side. And the last part of the business, and I think this is the more complicated part of the business, is raising institutional private equity to invest in deals. And we're in the process of a fundraise. We're increasing the size of capital under management. And what we're seeing is more and more investors that have lived through the cycle are turning to affordable housing and saying, well, it has a lot of characteristics that have made performance historically bad for me that is protected. So, for example, HUD pays a inflation-adjusted increase every year that is put together by economists. They're looking at the RGB increases and saying, well, that's really burnt me because it truly didn't keep up with expenses. Our answer is, well, for the most part, we get a true inflation adjustment that gets baked into our revenue number. And so they're excited about that. For the most part, people, we don't see as much turnover, and there isn't overbuilding that could affect us. So that part of the market is healthy. More people are looking into it. More institutional players are trying to stand up competing platforms, it feels like, which is also not great. I don't like hearing that. But overall, that market is healthy. There's a lot of curiosity, and there's people actually going beyond curiosity and investing. So we're seeing that market be in a positive trajectory as well. So across the four portions of the capital stack, I think overall we're feeling good. The market is supporting our business.
Terrific, thank you. Joe, last word on that.
No, I would just say that there are so many different lenders on different spaces. So, it could be a small bank, a middle bank, a, huge bank, I guess we would call it, a massive bank in TD. It could be debt funds. It could be CMBS. It could be Fannie and Freddie. Every day there's another debt fund that arrives in New York City with a different mandate. It could be these insurance companies. So there's just a lot of capital, I think, out there. I think every month, and I'm curious, like Shimon and your brokers, we're probably seeing more and more, which is a good thing. I like competition. It's better and it's healthier for the market.
Agree with that. And there is no shortage of competition in our space on this. All right, so I'm gonna, when I watch Michael Stoll and his shows from the day, he always had that glass apple, and to look into it and what the future looks like. So in a lightning round perspective, Gleb, I'll start with you. The city's faced with 500,000 units. We're short in affordable housing. But what does the future look like for you?
Look, I'm a big believer in the city, and it's a very hard thing to knock down. I think there's a lot of headwinds. I think 10% rent growth isn't healthy. It creates problems for the rest of the ecosystem. It's counterintuitive. You would think 10% rent growth is great, but then it creates various policies that end up potentially being counterproductive to the industry's health. I do think that ultimately the city finds its way to bounce back. We have a lot of talent. I think the administration has the ability to tap a lot of talent that is smart, that has been in this industry, that understands some of the stuff we talk about here, thinking that it's not resonating, is resonating. I think the office conversion opportunity, I'm not as close to it. Feels like if you could potentially unlock some of the regulatory barriers as to why it's so expensive to create a 2-bedroom apartment in an office building that presumably has the roof, the elevator shaft, the window, it's just very costly. If somebody could unlock that, that would be great. I think that the federal increase in tax credits is going to be matched by the city, and that will create more housing production. I think developer today is a good word within this administration. I think they know they need developers to produce. I mean, for the most part, it's affordable housing, but they recognize that any housing production is overall good. So I'm optimistic. I live in New York. I'm raising a family here. I'm hoping we are going to be in a better, stronger place, less volatile place, and there's going to be less tension, maybe more collaboration with the real estate industry than there was over the last 5 years.
Appreciate that positivity. Joe?
What was the question?
The crystal apple.
The crystal apple.
Come on, you've done the
ball.
crystal apple
Right.
before.
I'm joking. So I look at it several ways. One is, right now there's this discussion that everyone's moving to Florida. I think it happens every year around now, especially when we've been in a 1 month, deep freeze and, everyone's going down there, but according to Mom, it's pretty cold down there too. Secondly, I read a stat recently and I don't have it verbatim, but call it like 50% of the top 10 colleges, they asked the kids as they're graduating where they want to go, and they all wanted to come to New York, right? So you add in those people that are graduating, coming and getting their first job here, plus and I'll be politically correct, the legal migration push into New York as well, just naturally, it's going to continue to make this city incredible. People want to be here, people want to work here, people want to visit here. I don't have a crystal ball to tell you that, I'm optimistic, but I do believe it's not going to be this one day, we changed all the laws and everything's better. It's going to be, a state-ran insurance company for multifamily landlords. It's going to be the vacancy decontrol. It's going to be, I hear Trump may want some lower interest rates, so that may be coming. These little things, you sort of put it together in a soup, and hopefully that'll be a brighter day. But we're excited, we're here, we're open, and we're doing it. So
Love it. We go forward, but it's a grind. Those gears are grinding. Isaac?
Our job is to be optimistic, right? We were optimistic when everybody else were pessimistic, and we keep on being optimistic. When everybody here are going to be optimistic, right, and the market is going to be great, this is when we're going to move to the next market where people are going to be pessimistic. So we are believing in the city. We believe in the fundamentals. We have a lot of money invested in the city, and the city went through, in its historical, its history, ups and downs. New York is strong, and we think that it will remain strong.
Thank you for that investment and those words. Sam, you get the last word.
I agree with Gleb about the rapid increase in rents not necessarily being healthy. The irony there is that, like, for all of our existing in place deals, I think the struggle to produce more housing actually ultimately ends up working out kind of well for us in the short term. But I think long term, I do not think that's healthy. And I think pretty thorough answers here from the three before me. But clearly we just need to figure out how to start building bigger projects again. The fact that you have big, capable developers looking around for 99 unit buildings is absurd. You're not going to get to 500,000 building 99 at a time. It's going to take us a while. So I think that that's just an obvious statement. I think everybody in this room understands that. And then, there's some interesting things happening with, like, some of the ballot measures around. It's a bit tricky, but, like, some of those ballot measures are dialing back some of the kind of local influence on housing policy ultimately, and that obviously is a very delicate dance there. I think but ultimately maybe there's some nuance there that helps to unlock some things. The ELRP and some of the other things on the ballot measure that passed, I think could be helpful.
Ground up. Yeah, appreciate that. Thank you, gentlemen. This has been a wonderful experience for me to get to hear your thoughts, and give it up for this amazing panel today. And thank you all for your patience and your cooperation.